Thank you for joining us today for a member webinar with Aksel. My name is Jolene Olson. Outside of this webinar, feel free to email me if you have any questions regarding your membership or the TechCharts service. You could reach me via the Contact Us link that's on the website. Welcome, Aksel.
Thanks, Jolene. Thanks everyone for joining today's quarterly member webinar. We will be going through some interesting chart patterns that has taken place over the past 1 year. And we're going to be looking at some of the statistics in terms of chart pattern reliability. And then we're gonna look at a couple of interesting chart pattern developments that I'm seeing right now in the global equity markets. So let's start today's webinar. Long-term TechCharts members and Twitter followers, social media followers know that I like to draw chart pattern boundaries, horizontal chart pattern boundaries. I like to see several tests of chart pattern boundaries. So the next couple of slides will cover some of the features that I like to see on price charts, especially on the weekly and daily scale price charts. So let's start with the concept of several tests of chart pattern boundary. What do I mean by that? This will be a quick 4 slides introduction, so we can continue with the following slides with this framework in place. What do we mean by several tests of chart pattern boundary? So this is an interesting concept because when you draw trend lines, when you draw boundaries, you want to know that these boundaries are actually valid. Because penetration of such boundary should produce an immediate trend period, or at least a momentum in the direction of the breakout. So you don't want to just draw a line that actually doesn't exist, or that is not recognized by market participants. So the more a chart pattern boundary is tested, the higher the chances that the market participants have recognized this level as an important technical hurdle. So that is why we want to see, before a breakout takes place or a breakdown takes place, we want to see several tests of chart pattern boundary. So 1, 2, 3, 4 tests, and then after the 4th test, the breakdown takes place. So this is the concept of looking for several tests of chart pattern boundary, and that's the idea behind it, to understand that actually a supply and demand area is available, is present around that level that we're looking at. So the second concept is looking at chart patterns in the context of broader price action. So I get questions sometimes, is this a head and shoulder top, or is this a head and shoulder bottom? Is this a cup with handle reversal? Now, when we're looking at chart patterns, we have to make sure that the chart pattern that we're analyzing, or the chart pattern that we are identifying, is actually doing the job of what it should do. A head and shoulder top should be at the top of a trend. It shouldn't be in the middle of a price action, in the middle of a trend. Or a cup with handle is a continuation chart pattern. So if it is going to appear on the price chart, it shouldn't be at the bottom of a trend. In fact, it should be after an advance, form as a continuation chart pattern. So in the case of, for example, a head and shoulder top, there has to be a clear uptrend that has taken place. If you want to confirm the uptrend that has been intact, you can put a 200-day moving average, which I will discuss in the following slide. The 200-day moving average is a trend filter. So the price that is moving above the 200-day moving average is an uptrend. And when the reversal takes place, the price falls below the 200-day moving average. So the two things are taking place here. First of all, we're identifying a 7-month long head and shoulder top at the end of a steady uptrend that has lasted many months. So the left shoulder, head, right shoulder, the neckline that has been tested several times, and then the breakdown takes place below the 200-day moving average. So basically, you're seeing a trend reversal here. The trend that has been intact above the 200-day moving average, now is falling below the 200-day moving average with the completion of a reversal chart pattern. Now we can label this as a head and shoulder top. So the context of broader price action is basically explaining this, looking for the direction of the trend prior to the chart pattern formation, where the chart pattern is taking place. Identification of a launching pattern. Now this, the launching pattern is not a must, but when we see those type of chart patterns developing inside larger scale chart patterns, it increases the conviction of the breakout or breakdown that's taking place. So you can play two things here. One, you can play the 7-month-long rectangle breakdown. Two, you can prepare yourself for the major reversal and play the 14-month-long head and shoulder top. But what here we want to see is with the launching pattern is that a much lower risk entry points at the time of the breakout from the shorter duration chart pattern. The longer term chart pattern is a 14-month-long head and shoulder top. The right shoulder is forming as a 7-month-long rectangle. Again, on this price chart, you can see the horizontal boundary that's been tested several times, and then the breakdown taking place below the 200-day moving average as a reversal. So the trend that has been intact and it's been upwards prior to the top formation is taking place and forming a major reversal. And following the reversal, we're seeing the sharp sell-off. These were some of the breakout alerts on TechChart's website. The next concept is 200-day moving average as a trend filter, utilizing 200-day moving average as a trend filter. Now, what do I mean by this? You see a 3-month-long symmetrical triangle, and we also see a 9-month-long head and shoulder continuation. You can see that the right shoulder is acting as a launching pattern at this point. So we have double conviction. Head and shoulder continuation ready to break out to all-time highs, plus a nice symmetrical triangle that is being developed. Now, when we put the 200-day moving average, what we see is that the symmetrical triangle took place above the 200-day moving average. Every time it came back, it found support. It found support. It found support. And then eventually, we started seeing some buying pressure coming and pushing it to the upper boundary of this head and shoulder continuation and the symmetrical triangle. Now, at this point, remember, symmetrical triangle is a neutral chart pattern, but head and shoulder continuation is a bullish continuation chart pattern. So at this point, we have a conviction that the symmetrical triangle will act as a continuation chart pattern as well. Given that we are above the 200-day moving average, the trend is upward. So the wind is blowing behind us. So we're going with the trend. When the breakout takes place, this is double confirmation. So we use the 200-day moving average as a trend filter. If a chart pattern forms below the 200-day moving average somewhere here and then breaks down, then we can see that 200-day moving average acted as a trend filter, and we positioned ourselves or prepared ourselves for a bearish development, a bearish continuation, a breakdown on the downside. So we would take the breakdown on the downside at that point. Whereas in this case, we are above the 200-day moving average, breakout on the upside. So we tick the boxes. Head and shoulder continuation, horizontal boundary, several tests of chart pattern boundary, symmetrical triangle as a launching pattern, breakout. So basically, we're looking at a couple of futures that increases the reliability of the breakouts. This one doesn't happen all the time, but when it takes place, it is a really good signal, and I like to take those type of signals and post it on the TechChart's website. If I see a rectangle that is not breaking out to all-time highs, versus a breakout to all-time highs, I would prefer the breakout to all-time highs. So this was a recent breakout alert from UK stock market. Year-long rectangle, a nice setup after several tests of pattern boundary. The breakout takes place. This is a breakout to all-time highs. So what do we mean by breakout to all-time highs? This is a very difficult a signal to take most of the time, because the common behavior is that the stock went up too much, it's too expensive, breakout to all-time highs, it will fail. But what I would like to discuss here is that a breakout to all-time highs is uncharted territory. So we don't have resistance in this in the uncharted territory, and the momentum usually builds. Yes, there can be failures due to market trends changing, overall market sell-offs, and some stocks that have broken to all-time highs can fail. But usually, you would like to go with the trend. You would like to go with the path of least resistance. And the path of least resistance is breakout to all-time highs. So when I see a breakout to all-time highs, I like to prefer those type of setups. Now, over the past year, there has been 190 breakout alerts. Out of those, 152 were on the long side, 38 was on the short side. There are two tables here. The table on the top is all the signals, all the breakout alerts from the chart patterns that I have identified. Please note here, those are the chart patterns I have identified. So when I put this service out, I didn't want this to be an alert service. I want this to be an educational service. So whoever is a member and seeing those breakout alerts, I would like to give them the overall idea of identifying those chart patterns so that they can apply their own research and get better at it and find more chart patterns. And we're coming to that point where if you follow the global equity markets report, at the bottom of it, we have a discuss section, and we started seeing now members chipping in with their own findings and really good findings. And this community now started discussing basically the chart patterns in the way we have been looking at for the past 3 years. So when you're seeing that I have identified 228 rectangles, probably there are 500 rectangles. It's just there are too many opportunities that sometimes I get to select the best looking ones, or the ones that are breaking out to all-time highs and so on. But there are definitely more breakout alerts there than what I have identified. So the table at the top is from May 2017 till today, till the end of April, mid-April. And the second table at the bottom is the chart pattern breakout signals over the past 1 year. Now, an interesting thing that you will see here is that the top three is basically the same. Head and shoulder bottom has been a successful chart pattern. Head and shoulder top was a successful, and rectangle. Now, given that we have more occurrences on the rectangle, clearly rectangle is more robust between all the chart patterns. But let's not forget, I have a bias towards identifying more rectangles on price charts, because they are easier to identify, they are more reliable, and these are horizontal chart patterns. So that's why you might be seeing more rectangles, but that doesn't mean that when a market is reversing, I'm not highlighting head and shoulder tops or head and shoulder bottoms, but these are the numbers that were featured on the global equity markets report. So the top three has been head and shoulder top, head and shoulder bottom, and rectangle. And their success rate has been good. Symmetrical triangle is the only diagonal chart pattern that is being analyzed. I'm not looking at wedges. I'm not looking at double tops or double bottoms. These are basically discussed under the rectangle. So a rectangle reversal or a rectangle bottom reversal and top reversal. So basically, those are the most important chart patterns that I'm featuring on Global Equity Markets Report. Now, let's move and see what each labeling on price charts that are published on the Global Equity Markets Report mean. This is a weekly chart. My default time frame is weekly. I go to dailies, and then sometimes when we have really good breakout opportunities, I look at monthlies. Lately, I have featured several monthly scale price charts, long-term breakout opportunities. The markets has been volatile, but some stocks have clearly formed those perfect consolidation ranges and ready to break out to all-time highs from lengthy monthly scale consolidations. So when we look at the weekly scale price chart here, the green line is the daily closing price after breaching the 3% threshold for breakout confirmation. So let's say we have 13.90 as the upper boundary. We take 3% of it, extend it on the upside. That is our breakout confirmation guideline, as stated by Edwards and McGee in their book, Technical Analysis of Stock Trends. Now, what does that mean? Do we wait for a weekly close? No, we wait for a daily close above this level. Even though the chart is shown on the weekly scale, we would like to see a daily close above this level. So the end of day, we look at the price. If the price closes above the breakout confirmation level, we take it as the entry level. So this is the daily close on that day inside this week. Now, it ended up being a very strong week, and the weekly close was at the highest. Do you trade only on weekly scale price charts? Let's say yes. You can still buy this breakout at the end of the week. Now, your risk rewards will change, your entry level will change, but this also allows, if you are a longer term investor, acting on the weekly scales. The red line here is a subjective level at which the chart pattern will be negated. It's a subjective labeling of a pivot point inside the boundaries of the chart pattern. So when I find a minor low inside the chart pattern, I place the chart pattern negation to that level. Now, this doesn't mean this is the stop loss. Stop loss can be a little bit closer to the chart pattern boundary. Always, I suggest giving some room. But this is not a stop loss. This is a chart pattern negation level, which can be used as a stop loss as well, though it would be wide. So the symmetrical triangle price target is calculated, chart pattern price targets. There are several educational videos on the website, but let's mention it here. Taking the depth of the chart pattern at the widest point here, adding it to the breakout point, you get the symmetrical triangle price target. So we also mentioned that on the reports. So basically, these are the labelings that we always see in the breakout section, in the watch list section, in the review section. Now, let's move to the phases of market trend over the past year. You can see that it's been a roller coaster. But even in this roller coaster, there were periods where we had some steady trends, we had some nice consolidations, and we had a nice downtrend. Now, this is covering the past 1 year on iShares MSCI All Country World Market Index ETF. Why did I take this? Because I think that this is a global standard, a good representation of the global equity market's performance. It includes developed, emerging, and frontier market equities inside. The red line here is the 200-day moving average. I always use 200-day moving average on daily scale price charts, and on weekly scale price chart, I use the 40-week moving average. So these are basically equal to each other. From May till mid-October, we had a perfect rectangle consolidation. During this consolidation, the ETF tested the lower boundary, upper boundary, again came back to the lower boundary, probably here, I can't remember, but we have seen some short ideas as the index was challenging the 200-day moving average, and possible breakdown could have taken place. So as you can see, I'm going to touch into those a little bit later. Short ideas were 20. So the ETF recovered from the lows, tested the upper boundary, and then this time found support at the 200-day, didn't even touch the lower boundary, and then we consolidated few days and the breakout took place. So this was the second half of October. Till mid-January, we had a nice steady uptrend, a clear steady uptrend, a strong uptrend, followed by a double top. Two minor highs were completed on the downside with the breakdown of the 200-day moving average, and the sell-off followed. Now, during these periods, phases of market trend matters in finding chart pattern opportunities. Let me be clear here. I never look at the index charts and dictate my research in that direction. What I do is a bottom-up approach. So the bottom-up approach is basically you have a basket of instruments, you go through those charts, you find opportunities, you come across several head and shoulder tops. That basically signals that a market reversal is taking place or about to take place. You see several bullish continuation chart patterns, rectangles forming after a steady uptrend. You see these continuation chart patterns, you say that, okay, the market is strong and probably we're going to see more continuation on the upside. So these individual findings basically resulted in the breakout alerts. And when we look at them and when we put them on the price chart, we have confirmation. We can see that during this rectangle, during this May to mid-October period, we have seen 72 breakout alerts, 44 were successful, 61% success rate. Long ideas were 52. So more long ideas. Yes, the trend has been up prior to that. Out of that, 32 was successful. Success rate of the long ideas were 61.5. And we had 20 short ideas, out of which 12 was successful. Success rate was 60. So basically, almost a little bit neutral market, given the success rates with the short ideas and long ideas. But you can see that given that the prior trend was up prior to May, beginning of 2019, we had more long ideas. So the phase of the market trend mattered in finding chart pattern opportunities. And then came the stronger phase of the market, which was the uptrend that I labeled here. You can see that there were 62 breakout alerts. Long ideas were 61, short only 1. So in a strong trend like this, where most of the stocks are above their 200-day moving averages, rarely we see major top formations, or at least in the time frame that I'm looking at, 2 months to 24 months weekly scale price charts, rarely developed major top reversals. Out of those 61 long ideas, 40 was successful, 66% success rate. Overall, it was 66%. Short idea, one of them was successful. Gives us not a very meaningful 100% because there is only one sample. Now, mid-January, things started changing. So we formed the first top, and then came the second top. Around this period, January, now we're going to start looking at the charts. Around mid-January, we started seeing top reversals. Whereas at the same time, we were seeing still breakouts to the upside. Now, what happens to those breakouts when the market collapses like this? If it was a period like this, where we were in a flat range, and the moving average, the index was moving around the 200-day moving average, more neutral, we probably would have seen more successful long ideas. But what happened here was long ideas, out of 36, 13 was successful. Success rate dropped to 37. But at the same time, short ideas appeared. 17 short ideas. Out of 17, 17 were successful, giving us 100%. So what happened is that in a strong downtrend like this, all of a sudden, the market dictated us with short opportunities, top reversals, major breakdowns, and obviously, as I saw those opportunities, I put it on the breakout alerts and the watch list and took advantage. Now we will go and start looking at the type of breakouts that took place month by month. And let's keep in mind this chart as we're going through different chart pattern breakouts that took place. This was a US equity, 2-year long ascending triangle. So we are somewhere in May. The breakout took place. So the first half of the year was an uptrend. Let's go back. You can see that first half of the year from May till end of December, end of January, this was an uptrend. In an uptrend, the wind is blowing behind us. So we have the advantage of the trend. And you can see this stock breaking out after a slight pullback to the chart pattern boundary, resuming higher and reaching the price target. Now you can see that the price target is a little bit different here because the stock have experienced a stock split. So I have adjusted all the levels accordingly, but the price target has been met as if it was 785. The dividend that is received is basically included in your account at the time of price reaching 770. The remaining part would be the dividend. The next chart is from UK Glencore. Now here's an interesting idea here. Glencore is a commodity play, energy commodity. And we have seen commodities experiencing massive pressure, even starting from beginning of 2019. So this chart started developing that head and shoulder top, and we identified it in mid-May. So the breakdown took place, but the stock didn't start selling off until later in the year. As you can see, there was a steady uptrend. Let's remember the first four concepts, first four slides that we have discussed. There has to be a steady uptrend to reverse for head and shoulder top. Left shoulder, head, we break down the 200-day moving average, we rebound, and then the right shoulder forms. We broke down the neckline that has been tested several times, which was also a horizontal. We broke down the neckline, and following the breakdown took place below the 200-day moving average. So now a downtrend is confirmed. A minor pullback was followed by another sell-off. This formed another descending triangle here. So the descending triangle basically acted as a pullback, but you can see that it formed below the 200-day moving average. So when the breakdown took place, we were convinced that already the trend is down, already we are below the 200-day moving average, and the breakdown is taking place. So this breakdown took place in the first months of the new year, resulted in a sell-off. Now, even though the stock started forming a major top way before, the major sell-off part didn't start until the global equities started a sell-off phase. But if you look at, for example, the second half of 2019 and the beginning of 2020, while many stocks moved higher, for example, this one, this stock underperformed massively. So stock selection is important. And most of the time, just applying a 200-day moving average will give you a better view of what is happening in different sectors, on different stocks. And added to that, if you apply the chart pattern classical charting principles and time your entry with the breakdowns, it even adds another level of edge into your decision making. The next chart is Novocure, listed on the Nasdaq healthcare stock. So this is again May, June, July. These are when the all country world index ETF was in a consolidation range. We still had stocks that were breaking out to all-time highs. So this is an all-time high breakout. 2 times test, the third test, the fourth was a breakout. 200-day moving average was trending up. We reached the chart pattern price target in a couple of weeks. So this was a strong breakout to all-time highs. Infosystem in India, a steady uptrend, 200-day moving average. The rectangle, 4-month-long rectangle, eventually finding support at the 200-day, another support at the 200-day, and this is the breakout week. After the breakout week, we see a couple of weeks of consolidation above the chart pattern boundary, and then the trend resumes higher. We reach the price target. Now, sometimes rectangles can form as top reversals. This I labeled as a top reversal. It has been a chart that I have been following for some time. And it's a Japanese name, industrial company, weekly scale, 19-month-long rectangle, several tests of the chart pattern boundary. And we started testing the lower boundary several times. And here we got the breakdown signal. But this was July. So July-August period. Now let's go back. Phases of market trend. Let's go back. Here, July. So end of July, August. This is the time where we probably started seeing those short signals, but the market recovered immediately in August, September, resulting in some failures on the short ideas. So the market trend actually impacts how the shorts and longs perform. Can we know in advance? No, we cannot know in advance. It just confirms each other after some time, but we just need to take the signals as we see it. So this was a sharp reversal on the upside, which the chart pattern negation was reached in few weeks. Here, another stock from Australia, Beach Energy. It's an energy company, formed a 10-month-long cup with handle. So this is the cup, this is the handle. The breakout takes place. This is a breakout to all-time highs. Stock continued higher, pulled back. We're in August, pulled back, and then wanted to continue higher even more. As we got closer to the beginning of the year, energy stocks, commodity stocks, started seeing pressure, and this stock failed to reach its chart pattern price target. So basically, the environment was not ripe for this stock to make it to the chart pattern price target. And then we reversed, we broke down the horizontal boundary and the 200-day moving average. So the trend reversal took place here. Now you can see that chart pattern negation level is at 1.8. As I said, for some of you, you can place a much tighter stop loss, but the chart pattern negation level and stop loss are two different things. So you might actually be getting out of this stock at an earlier level without waiting for the chart pattern negation level to be reached. But the statistics that you have seen are either the stock reaches the chart pattern price target or the stock reaches the chart pattern negation level. So the success rate is basically calculated with those two things in sight. The next chart, we're now in around November. By the way, these are just samples from all the breakout signals that has taken place during this period. Might be a representation of the trend at the time, but there were clearly more signals at the time during this one year period, 190 signals, I don't think we will have enough time to review all those, but they are all under the breakouts page. So you can go and click on the plus sign, and each report's breakout alerts will open with the charts prior to the breakout, at the time of the breakout, and at the time of the completion. So basically, what you're seeing right now is on the breakouts page for each breakout alert. So this was a stock from Hong Kong, Kingboard Laminates Holding, a nice head and shoulder bottom. At the time, we started seeing Chinese companies forming head and shoulder bottoms. We have seen several head and shoulder bottoms in Chinese names, and I have published those on the report. And this is one of them. Left shoulder, head, right shoulder. Right shoulder formed as a nice rectangle. The breakout took place above the 200-day moving average. Now, what I like about this is that the rectangle started testing the 200-day moving average. And when the breakout took place, there were two signals, actually three signals. One, the right shoulder, which was a rectangle, completed on the upside. Head and shoulder bottom completed on the upside. And also we cleared the 200-day moving average. This was followed by an upward move, and then a pullback, and then continuation to the price target. The next chart is from Portugal, EDP, a nice year-long cup with handle. Now, cup with handle, can it form as a bottom reversal? No, it is a continuation chart pattern. What do I mean by continuation chart pattern? The prior trend should be up, and then we form the cup and the handle, and the breakout takes place. If this cup with handle forms at the bottom of a price chart, it is not a cup with handle. It is probably part of an ascending triangle that is acting as a reversal chart pattern. Cup with handle is always a continuation chart pattern. So we formed this cup with handle. It is a year-long cup with handle. Breakout took place, pullback. You see the slight breach of the chart pattern boundary. Now, the prior webinar, TechCharts members can go to the past webinars and look at those. We've studied 4 types of breakouts. A chart pattern that breaks out and pulls back to the chart pattern boundary, retests. And then there are the hard retests, which penetrates below the chart pattern boundary. There are those breakouts that doesn't even pull back and just continues. And there are those breakouts that immediately fall back below the chart pattern boundary and fail. This can be classified as a hard retest. If you have a little bit loose stop loss, you will survive these type of pullbacks. If you have a very tight stop loss, you will get stopped out. In that webinar and some other communications, I have stated that if you are using very tight stop loss and getting stopped out in such type of hard retest, you should have a re-entry plan placed to be able to participate in the recompletion of the chart patterns or the continuation of the chart pattern. So this stock continued higher, pulled back this time exactly to the chart pattern boundary, and continued higher to its price target. Cup with handle, we take the depth of the chart pattern, add it to the breakout point, and we get the price target. The next price chart is again from November. Now we're getting closer to the end of the year. It's a financial company, Norway, ascending triangle, breaking out to all-time highs. You can see the several tests of chart pattern boundary. So because we are discretionary traders and classical charting principles is a subjective tool to analyze markets, I try to be as consistent as possible with the chart patterns that I'm featuring on the TechCharts website. So that's why I discussed those qualities that I'm looking at. Sometimes I might deviate from those, but minor deviations. But most of the time, I look for the similar setups. Chart patterns with horizontal boundaries, several tests, breaking out to all-time highs, completing above the 200-day moving average. This was another great example. Now, the only problem is that it didn't reach its chart pattern price target. What does this mean? Does this mean that the chart pattern failed? No. At this point, the trading tactics come into play. How you're riding those trends, what kind of trailing stop you're using. Are you using a trailing stop loss? All those things are discussed in different webinars and educational videos. There is now more than 30 educational videos. Maybe we reached 35 on TechChart's website. You can check all those, and there are several discussions on ATR-based trailing stop losses, moving averages as trend following tools. So what happened here is that most probably in the beginning of the year, the headwinds of the global sell-off resulted in a reversal, even though we were forming a minor continuation here, a short-term continuation that could have hit the price target. That didn't happen, and a reversal took place. But this was a perfect 16-month long ascending triangle. Here is another ascending triangle. This time it's a shorter duration. This is a daily scale price chart, 3-month long ascending triangle on Microsoft. Several tests of chart pattern boundary. Breakout takes place with a breakaway gap. This is the day, the closing day, above the breakout confirmation level. Chart pattern boundary. A short-term consolidation that's taking place, and then the trend resumes higher to reach its chart pattern price target. This is again a breakout that took place in November. Now, here's a symmetrical triangle. Why did I put this chart? There were symmetrical triangles that have succeeded, but I want to draw attention to one of the problems with the symmetrical triangles, in other words, diagonal chart patterns, is that when we see a breakout, here the Microsoft chart, here Norway Sparebank, when we see a breakout, the consolidation is taking so long that there's a lot of energy built into this. So the minute that we see the breakout, we don't want any other hurdles. We want to set free. We want to move higher fast. We want to capture that trend period. So why would we want to have an immediate resistance following the breakout? In the symmetrical triangle, the immediate resistances are the minor highs. In this case, the stock, Bancolombia, found resistance at the minor high. This was a perfect 5-month long symmetrical triangle that found support above the 200-day moving average. Every time it came back, it found support at the 200-day moving average. But this one, this breakout, immediately found resistance at the previous high, and then reversed back inside the chart pattern. So this is the problem with the symmetrical triangles. Now, let's not say that all symmetrical triangles fail like this, but there's a higher chance that we will find immediate resistance. So that's why I like to focus on the horizontal chart patterns that break free, that clear the horizontal boundary and have limited resistance immediately after the breakout. This is another chart pattern, 16-month long cup with handle from France. Horizontal boundary, 1, 2, 3, 4th time the breakout takes place. The stock moves higher, but again, due to market trend, the major sell-off. Now, if here is something that I have realized, especially after the correction, after this sharp sell-off, it was very difficult to find perfect chart patterns, developing chart patterns. Why? Because usually the market's corrections do not take place like the one we have seen in the pandemic. This time, everything sold off. So when everything sells off in a market crash like this, there is very limited place to hide, very few names to hide. So it is very difficult for stocks to at least consolidate during that time, at least hold on to their gains until the correction is over. During most corrections, we see those type of price actions where a stock that has already broken out and traveled the distance consolidates in a forming a rectangle until the market picks up in momentum. But this time, starting from January, February, almost everything sold off. So all the long ideas that were in play reversed and fell back below their chart pattern boundaries. That's why during the same time, immediately, we have seen a massive short ideas developing um, and telling us that the market is reversing. This was a stock from Switzerland, healthcare. Very few places to hide. One of them was healthcare. So January 2020, rectangle continuation, several tests of chart pattern boundary. Here we get the confirmation. After the confirmation, we didn't even see a pullback. The stock rallied to its price target. A perfect rectangle, 7-month long rectangle completing on the upside. This was another perfect 30-month long rectangle. Now consumer non-cyclicals. Consumer non-cyclicals breaking out in February probably is the result of a risk of in a risk of environment, a safe bet where most of the fund managers pile their cash into those type of non-cyclicals. That could be the explanation for a breakout like this strength. So what happened here is that several tests of chart pattern boundary breakout takes place without even a consolidation. The price target is met. This was a stock in Netherlands. Turkey, Doko, this was listed in Austria as well. It's an Austrian company. So what do? They do catering for the airline industry. So what a bad sector to be in. But interestingly, the first breakout, which took place from a 6-month long rectangle, managed to reach its price objective. But due to the market phase, market trend, it failed to reach the ascending triangle price target at 713. So even though the initial breakout was successful, afterwards the momentum stalled and the stock started falling similar to the other names. So this was also a breakout to all-time highs after several tests of chart pattern boundary. So you can see the consistency here. Irrespective of how the market reacts, how the stock reacts, or the outcome of the trade, I'm basically trying to be as consistent as possible with the picks and with the qualities that I look for with those breakouts. Now, in January, February, things started reversing. You remember the All Country World Index ETF, the minor peaks, double top completing, and we started seeing more and more short setups. So this was an airline company in Japan. You can see the descending triangle. First test, second test, third test, fourth test, the breakdown takes place with the gap. Immediately the gap is filled. This was a pullback. So you can see that also the breakdown is taking place below the 200-day moving average. This was already an established downtrend. So even when you're going to go for short ideas, make sure that the momentum is down. So stocks that are below their 200-day moving averages are indicating that already there has been a downtrend in place and a distribution has been taking place. So with this type of a breakdown, the last sellers basically pushing the price to lower levels. So you want to participate here in this short setup. Descending triangle price target was met immediately following the breakdown. This was a stock from France, ascending triangle 5-month long. Again, in February, one of the long ideas that even though the breakout was solid, pulled back and then tried to move higher, failed to reach its price target and fell back below the chart pattern boundary with the global market weakness. Symmetrical triangles can act as continuation or can act as reversal. Unlike descending triangle, for example, the right angle triangle, descending triangle has a bearish bias due to its downward sloping upper boundary. So sellers are impatient. At every rebound, sellers are acting earlier. At every rebound, sellers are acting earlier, and buyers are trying to hold the price at the same level. Eventually, they are giving up. They are not able to do it. Selling pressure wins, and the stock continues lower. So descending triangle has a bias, directional bias. Ascending triangle has a bullish bias. So the buyers are impatient. Buyers are bidding the price at higher levels at every correction. So the stock is pulling back, buyers are at this level. Rebound, buyers are at a higher, buyers are at a higher, buyers are, eventually the buyers are winning the battle. Whereas with the symmetrical triangle, you can see that it is neutral. So both buyers and sellers are in a battle here. Now, what differentiates the symmetrical triangle from a reversal or continuation is the final breakdown. Again, let me be clear here. With all chart patterns, we would like to see a breakout, but that doesn't mean that we don't see the bias. Here, we don't even look at the bias. There is no bias here. There is no directional bias. So the lower boundary was tested several times, the upper boundary. Now, when the stock was testing this upper boundary, I was ready for a breakout higher. Why? Because the prior trend is up, the trend is up, okay? So we are above the 200-day moving average. If there is a breakout and a strong breakout, this can act as a continuation that can lead us to the upper, to the minor high. But what happened is that immediately after testing the upper boundary, stock reversed and this time tested the lower boundary. Now at this point, I started thinking about a breakdown because we are now, if there is a breakdown, we will be below the 200-day moving average. As you can see, you shift your focus depending on what the last value is telling you. So more information comes in play. You adjust your decision making with the breakouts. In this case, as we move to the lower boundary, be prepared for a breakdown. If the breakdown takes place, this can act as a reversal, which acted as a reversal. Immediately, the sell-off followed. In fact, a few weeks of pullback was followed by the sell-off. Now, February, we started seeing January-February period, we started seeing those massive head and shoulder tops. It was a financial company, US Credit Corp, perfect left shoulder, head, right shoulder. And prior to that, in the beginning of the year, those stocks were still on my watch list. And I was looking for possible head and shoulder failures. You'll see if you're testing the upper side of this consolidation here and trying to push above the 200-day moving average, you're getting prepared for a possible head and shoulder failure. But what happened was immediately after that sell-off followed, we tested the lower boundary for the third times, and then the breakdown took place. Signal. Head and shoulder top confirmed. This was a clear uptrend. Reversal took place below the 200-day moving average, and then the sell-off followed. 20-month long head and shoulder top. The next chart is from Germany, February again. So we have a nice steady uptrend. This is a daily scale price chart. Left shoulder, head, right shoulder. Now, when you look at the right shoulder, what do you see here? A rectangle. Rectangle acting as a launching pattern. So we have a higher conviction with this breakdown. The breakdown took place from the rectangle and the horizontal neckline. 1, 2, 3, 4 times. The fifth breakdown is a clear signal. And following the breakdown, a pullback to the chart pattern boundary, and then the price resumed to the price target. 6-month long head and shoulder top. A rectangle in UK from energy sector, it has been on the watch list for a long time. I even had the price target for the upside, price target for the downside. So the rectangle was forming above the 200-day moving average. Here, as it was testing, I was prepared for a possible breakout. What happened was it immediately reversed. reach to the lower boundary. Now I'm ready for a possible top reversal. Rectangle acting as a reversal. And you can see several tests of the chart pattern boundary. Breakdown takes place and price target is met in a couple of weeks. So as you can see, the new data comes in and we adjust our thinking accordingly and be prepared for either an upward breakout or a downward breakdown. You remember the airline stock in Japan, a descending triangle. This is also another 14-month long descending triangle that completed in the US equities. So you can see 1, 2, 3, the fourth test broke down the lower boundary in March, and immediately after that the sell-off followed. 14-month long descending triangle completed on the downside. As you can see, the upper boundary of the 14-month long descending triangle is showing the bias, the bearish bias. Rebound finding at a lower level resistance, again at a lower level, and eventually the sell-off is taking us below the horizontal boundary. So those were basically the sample chart patterns that we have identified over the past 1 year. TechChart's Global Equity Markets Report is covering developed, emerging, and frontier market equities. And in those equities, I try to look at chart patterns from 2 months to 24 months duration, mostly weekly and daily scale price charts. As I said, lately I started seeing some good long-term charts. Some of them are on monthly scale. Let's have a look at what I'm looking at right now. These are two different charts. One of them, the right side is my favorite, but let's have a look at the left one from US Internet Index Fund, FDN. This is a monthly scale price chart. You can see this perfect ascending triangle breaking out here, and a similar 2-year long consolidation probably has taken place and completed, and now we are seeing this breakout taking place. The lower boundary is at 108, upper boundary 151. So this month's candle, if we are able to close strongly, it will be a monthly signal as well. But on the daily scale, we have seen the breakout confirmation. Similarly, we have seen a breakout confirmation on this Japanese company, Shimano Corporation. Now you're probably hearing a lot about the electric bikes and that industry. So these guys might be involved. I'm not following the fundamentals, but probably there might be a story around it. It's a multi-year long rectangle, several tests of chart pattern boundary, and this is a strong monthly candle that is breaking out to all-time highs. So this is a long-term opportunity that I'm looking at. Another chart on the left side from Denmark, basic materials. You see this a perfect ascending triangle. Now we are forming a bigger one, multi-year long ascending triangle with the horizontal boundary several times tested. Price target is at 500. It's a monthly scale price chart, and a breakout can push us to all-time highs. This stock on the right-hand side is from UK, an industrial company. It is also trying to break out from a nice 11-month long rectangle. And this is another exciting chart that I'm looking at right now. We have one perfect breakout that has taken place this week. Take two was on our watch list. So it's an 18-month long symmetrical triangle. There are 3 touch points of the symmetrical triangle's upper boundary. This week's breakout cleared the upper boundary, and you can see that it also cleared all the minor highs. So a strong weekly close like this will also be a nice weekly signal that cleared all the resistances. This is also a breakout to all-time highs. The other chart that I'm watching is from Hong Kong, Sino Pharmaceuticals, biopharmaceutical company, healthcare, a 7-month long rectangle, several tests of chart pattern boundary. It just needs one push, clear breakout. that will take above the 200-day moving average. Earlier, the stock formed a nice head and shoulder bottom here that completed above the 200-day moving average, reversing this trend. And now this can act as a continuation with a price target of 14.8. So that's also on my watch list. That's it from my side. Jolene?
Wonderful. Thank you very much, Axel. We have about 20 questions waiting in the queue right now. So I'm going to start sending them through, and then just let me know when you've taken your last question. Thank you.
Question 1. When analyzing charts for possible trading opportunities, do you use good liquidity in the market as a trade filter? And what method do you use to determine good liquidity? So what I have done is that I created my research universe with the stocks that are more than $500 million market cap. Lately, I went down all the way to $100 million, but this is like a sub portion. The most of the ideas are coming from stocks that are larger than $500 million market cap. I'm not looking at volume. I'm not looking at liquidity. So when you see these opportunities, it's better to have a look at the volumes according to your needs, according to your trading size. It's very difficult to serve all our members. Some have smaller portfolios, some are bigger funds. So that's why I like to put those charts ahead of time to give you enough time to do the due diligence, be it the fundamental filtering, be it the volume filtering. But my filtering is stocks that are bigger than $500 million market cap. Question 2. It will be nice if the performance of chart alerts can be tracked in an Excel sheet. Yes, this will be available. Now we're going to make those tables available on the breakouts page. And I'm planning to add more statistics, like, for example, other than the chart pattern reliability, which chart pattern have succeeded and not. I'm going to also add if the chart pattern was a reversal, continuation, what was the chart pattern negation level, and so on. So these will be placed on the breakouts page. Question 3, how often do you trade personally? Did you trade all of the patterns summarized in the phases of market trend slide? No, of course, you cannot trade all the 190 instruments. I take, in the global equity markets report, you see a correlation matrix. So this is one of the reasons we put the correlation. I put the correlation matrix there to look at stocks that are not correlated. So if you're taking 4, 5, 6 ideas at a time that are correlated, you're basically becoming too correlated with the market. So when selecting stocks, it is better to go with different exchanges, different geographies, and different sectors. That's why I try to put as many opportunities as possible so that we can pick and choose the type of stocks to trade. Question 4. I understand you don't like to use volume. It's not I don't like to use volume, but however, in technical analysis and stock market, Richard talks a lot about high volume or upward breakouts. Can you explain why you don't use this, at least for breakouts? Now, I have written a post on the volume as a confirming indicator. I'm not saying that volume shouldn't be looked at. Volume is good to have, and you can always look at volume at the breakout time. My experience over the past 9 years when I was managing funds in the MENA region was that it was an environment where liquidity was not that high, especially on different names. Yes, there were blue chips, but taking breakout alerts just based on volume would have limited my capability to capture good breakouts. So if a breakout is taking place and let's say you are less than 1% of the daily volume, that's already a good liquidity, good volume to enter into that breakout. If the volume is not there, why should you avoid this stock from your breakout signals. Yes, I understand if your size is too big, it might be difficult to get in or get out from those type of stocks. Then you can pick the stocks that have higher liquidity. Now, breakout with higher volume. Breakouts can take place and volume can pick afterwards. If you read that blog post, there is one example. One example is not enough, but there is one example that I have discussed that shows breakout can take place and volume can pick up later. So what do we do in that case? If we don't take the breakout just because volume is low, doesn't mean that that breakout can fail. We are basically trading price, and I like to capture the price movement. That is why I'm not using breakouts as a confirming indicator, but that doesn't stop anyone to use it as a breakout confirming indicator. It is clearly part of the technical analysis curriculum, and it is, for me, it is good to have. It is not a must-have. Can you talk about how you place stop losses after entering a position? There is a very detailed educational video. Actually, there are two under educational videos. They are somewhere around 5 to 10 minutes long. One explains stop loss placement on cup with handle, the other one on the head and shoulder top. These are ATR trailings, and there's a good explanation of how to calculate the ATR trailing. So this will give you guys an idea if you have a look at the educational videos section. Do you ever look at charts adjusting for dividends? Now, this is a common question. Different platforms are showing charts adjusted with dividends and non-adjusted with dividends. My data provider is Metastock. They take their data from Thomson Reuters. We compared Thomson Reuters data to the exchanges, and they match. So whatever chart I'm seeing, I'm basically taking it as the right data. So I'm trading based on those charts. Question 7. The statistics on page 7, does Aksel include failure signals such as head and shoulder failure, cup with handle failure, or even ascending, descending triangle failures, breaking out of the diagonal line? No, I don't include those. Those are failures, but one thing that I like to focus on in the near future is the head and shoulder failures. They are really successful. I have seen several cases of head and shoulder failures. I have even posted under tech chart study head and shoulder failures, and you can have a look at that. And there is also an educational video on head and shoulder failures. So maybe I should also include head and shoulder failures as breakout alerts. This is something that I will look into. Thank you. Question 8. Why do you ignore wedges? You mentioned this on slide 7. I just wanted to understand your reasons. Yeah, there's a short educational video on our YouTube page on wedges, on the latest wedge development on S&P 500. Do all wedges fail? No. Every now and then you find a good breakdown from a wedge, but wedges have diagonal boundaries. So when you break down a diagonal boundary, you correct. You try to find another low, and eventually the stock finds another low, and you draw another diagonal boundary. So it is very difficult to capture a nice trending period that gets out of a wedge, at least for me. So with the number of opportunities that I have, I'm comfortable with the horizontal chart pattern setups. Now, if you're looking at 10 names, obviously you would like to utilize as many chart patterns as possible. But when you're looking at 1,000 names, making it a habit to go through those 1,000, let's say NASDAQ names, making it a habit to go through, you will have the luxury to go and pick and choose the rectangles or the horizontal boundaries. You don't have to focus on wedges only or diagonal boundaries. So that's what I'm doing. I'm trying to go with what works for me and what I believe that it will work for majority of traders and investors, those horizontal breakouts are easier to identify. This is the most important word, I think, easier to identify, because our eyes like to see those diagonal boundaries, trend lines. Everybody that starts doing technical analysis, the first thing that they learn is to draw a trend line. So it's easier to draw a trend line, but it takes a lot of patience to wait for that perfect rectangle setup to appear on price charts and to take action on those. Question 9, slide 9, can you repeat your MAs for weekly and daily frames? 200-day moving average for the daily, 40-week moving average for the weekly scale. Question 10, slide 8, can you explain how you set your pattern failure level? The pattern failure, chart pattern negation level, is a minor low inside the chart pattern itself. Now, if there is no, at the weekly scale, let's say, if there is no minor low that we are seeing, okay, we go one level below, which is the daily scale, and try to find a minor low there. This is a subjective level. The only objective chart pattern negation, or maybe two, would be with the triangle, right angle triangle and symmetrical triangle, where the lowest part of the symmetrical triangle is, the minor low inside the symmetrical triangle, and head and shoulder failures, which is the lowest part of the right shoulder. So those are much easier to identify as chart pattern negation levels. Question 11, your charts are mostly weekly. Does it mean you disregard shorter time frame formations? If yes, why? No, I don't disregard. Actually, I started posting more dailies as well. It's just the shorter time frame you look at, the higher the risk of failure or morphing into another larger scale chart pattern. The daily price charts have higher volatility. It's easier for those chart patterns break out and then fail below the chart pattern boundaries. Question 12, your head and shoulder examples are all with horizontal shoulders. What is your view of inclined head and shoulder? It exists. There are several examples of downward sloping or upward sloping necklines, but as they are diagonal, I like to focus on the horizontal ones. That doesn't mean they don't work. A downward sloping head and shoulder top would have more negative implications than an upward sloping neckline on a head and shoulder top. But I focus on the horizontal ones to be able to place a protective stop above the horizontal boundary. Question 13, is it true some stocks follow classical chart patterns better than others over a long period of time? If we find those names, we should follow them long term, even if a chart finished this target negation. I agree with this. This is a very important point. I wonder, every day my time is limited to do this extra research. If anybody out there have done some research on this, I would be happy to sit down and discuss. Some stocks are quiet, some stocks are not. Nordic exchanges, we see stocks that are nicely trending. Middle East, North Africa, if you open Qatar index charts, constituents, or Saudi Arabia, or some emerging markets, you see nice trends. It would be great to be able to find some filtering criteria for those type of stocks and keep on looking at those and avoid the very volatile names. So if there is anyone who is doing some research, I would like to hear. Question 14, it would be extremely useful to add to the statistics the average ratio between target and negation levels with respect to breakout level. Yes, this will come. We're working on it. It will be placed on the breakouts page. Question 15, Have you ever used a pullback strategy? It seems quite popular for some traders. What percent of traders do you think are doing this? I don't know who is doing the pullback strategy, but there are different ways to enter a trade. One of them is not waiting for the breakout confirmation level, a portion of it. 2, waiting for the breakout confirmation. 3, buying at the pullback. So all those are different trading tactics, different trading strategies that you can try and see whatever fits best. But my suggestion would be sticking to one way of doing it and to be able to see the results. Question 16. Do you recommend using different stop strategy in terms of the pattern length, weekly ATR stop if pattern is more than? Yeah. So if you have a weekly scale price chart and you're okay to carry it on a weekly time frame, and you don't mind the volatility that the daily scale price chart will cause, you can stick with an ATR that is weekly scale. Now, if you go to the educational videos, head and shoulder top ATR trailing stop loss example is on weekly scale. So I use the weekly scale, weekly ATR, whereas the cup with handle is an example on the daily. So you can see the differences between two. The only difference is going to be the volatility that it causes during the move. So if you're okay with the weekly ATR, that's totally fine. But your time frame should fit that weekly scale. Question 17, page 20, the symmetrical triangle. Do you usually place negation level at the apex of the triangle because suggests that EM's book suggests that as a strong support? No, I place it actually not the apex, but a minor low inside the chart pattern itself. So a minor low. Question 18. Could you show us a breakdown of breakout success failure statistics by exchanges or countries' currencies? Is it relevant to those who do not trade signals in all exchanges countries? Yeah, if you look at, for example, US breakouts, I'm not sure if that's what you're looking for, US exchanges. Yeah, this can be also classified as a different column in those statistics that we will put out there. Yeah, we will look into this. Question 19. Are there national markets that demonstrate less emphasis on chart patterns, heavier percent of fundamental investors? I'm not sure about this, but I can say the opposite is true. Very little fundamentals were being applied at the time in Saudi Arabia. Obviously, if you have limited information, fundamental analysts working on valuations, your only tool ends up a chart. So starting from this point, if you have more fundamental coverage, it is possible that fundamentals, fundamental biased traders, investors would dictate the market. Possible. Sometimes you do not plot the 200-day moving average. Is there any particular reason besides the 200-day moving average? Do you use any other moving average? No, there is no particular reason. I do not plot the 200-day moving average because sometimes it is too obvious that the stock is above the 200-day moving average. The times that I plot the 200-day moving average is those times when I would like to show that a chart pattern is finding support above the 200-day moving average. It's hitting constantly to the 200-day on the upside or on the downside. Are you ever concerned with how extended the minor advance is in a stock prior to the breakout? FTN, for example, bounced straight from the lower boundary. Do we have to be careful of profit taking? Yes. So with those type of stocks or ETFs, I usually like to see a little bit of consolidation before the breakout takes place below the chart pattern boundary, but looks like this stock is not, this ETF hasn't done that. Well, it's a two-edged sword. It's a hot sector right now, and it can continue like this. So basically, it will be an idea. It will be a trade that you take with limited risk and see how it goes. How do you identify the price for horizontal and diagonal boundaries? The price, you draw the boundary, and that usually is the high price of that minor highs, and you check what that price is, and that's how you identify. I love to see the slide of statistics. Are there more studies available on the website, maybe also compared to different observed time frames? Okay, time frames. Yeah, I have categorized them as with time frames as well. Chart patterns with 17-month long duration, chart patterns with 2 months long duration. We can also put those on the website. Yeah, I will work on those as well. How do you treat spindles crossing the chart boundary during the weekly or daily chart development? Do you use a lower time frame to negate the false breakouts? Spindles can happen, but if you're seeing a spindle on the weekly, that doesn't mean that there is a breakout confirmation on the daily. So we would like to see a daily close above the breakout confirmation level. So that's how I look at it. The confirmation level is taken on the daily scale. In terms of timing, what is the time horizon you usually see breakouts playing out? It differs. For example, the chart pattern that you saw on Microsoft, it was a shorter term time frame, 3-month long, and it reached its chart pattern price target faster. Whereas Corbion, it was a 30-month long rectangle. Again, it reached its price target in 2 weeks' time. Sometimes it takes 3 months to reach a price target. It goes and it starts consolidating sideways for some time, and it's not clear, depending on the duration of the chart pattern, how long it will take for a price to reach the price target. How do you balance the initial stop loss positioning between chart pattern boundary and chart negation point to balance the position sizing and the risk as basis points in relation to the market volatility? Well, this is one of the reasons I have discussed about the ATR-based trailing stop loss, which also accounts for volatility in the markets. If you look at those 2 educational videos, you will have a better understanding of how they behave, and will definitely help. Last 2 questions. Between log scale and linear scale, which one is better? I use log scale. The reason for that is that I look at longer term scale charts. With weekly scale price charts, I load 5 years of data. With daily scale price charts, I load 1 year of data. In both cases, I use log scale. Price targets are also calculated in a different way. With upside breakouts, I take the price distance. With downward breakdowns, I take percentage distance. The reason for that is a stock cannot go below 0. Well, in the crude oil example, it went below 0. But a stock can, let's assume that the stock cannot go below 0. So a 10% drop should equal to 10% drop as well. So if you take the absolute number with penny stocks, you end up with negative numbers. For double tops, bottoms, or head and shoulders, is there a limit on the percentage, such as 3% between highs and lows on double tops, bottoms, or between right and left shoulders? No, there's. I don't look at that. I'm looking at the weekly scale price chart. If it's a head and shoulder top, it's a clear one. I take that. And as I said, for double tops or double bottoms, I classify them as part of a rectangle. So for me, they are more like a sideways consolidation that is completing on the upside or on the downside. These are all the questions. Thank you, everyone.
Thank you, Axel. Thank you, everyone, for joining us today. I'd like to remind you about a few items on our website. All of the member webinars are located on the website under Premium Members, Educational Videos, Member Webinars. We also have a Discuss platform that's on the bottom of every premium report. So if you go to Premium Members, Premium Reports, and then go to one of the titles of a report, click on that, then scroll all the way to the bottom of the report. You will see a Discuss platform there, and you can go ahead and enter your question. Axel is very good about replying. There's also a function that you can upload a chart, so please feel free to Send your questions and chart ideas there. It would be really great for the Tech Charts community. And if you have any other questions, you can send them to me on the support tab. So if you click on support, that's in the upper right-hand corner of the website, and click on contact, and that email will come straight to me. Thank you again. We really appreciate your membership, and we hope you and your family are safe and healthy. Thank you.